Hi, this is Blake Davenport with the Davenport Group in Long and Foster. On today's real estate tip of the week, we're going to be talking about the tax benefits of owning a home. So let's dive into this. So disclaimer, I'm going to throw out there right now, I am not a tax professional. You should seek your CPA, your accountant when doing your taxes, but this is just the real estate side of things. So you just have a general understanding of what the tax benefits are when owning a home. So when you own a home, your monthly payment will consist of four things, and that's called PITI. It would be the principal from the loan, the interest from the loan, the taxes on the property, and the insurance from the home insurance. And that makes up your monthly payment. Of those four things, and you could have more than four things depending upon your situation, like HOA or condo fees or private mortgage insurance. But of those main four things that most people have, you are able to deduct your property taxes and you're able to deduct your interest from your loan. So for example, say your monthly payment was $2,000 a month and your taxes and your interest made up $1,500 a month. That is $1,500 that you'd be able to deduct on your taxes each month. So I think that's like $18,000 altogether. Normally, that would be great. That you're going to be saving lots of money from that. But when you do your taxes, you can either take the standard deduction or itemize your taxes. And when you own a house, you typically would itemize your taxes, but you take what's ever greater, the standard deduction or the itemized deductions. Well, with the new tax law in 2018, that has completely changed this realm of taxes, and it's actually made it less valuable to own a house, and it's strengthened renting a lot more, and it's given people a lot more money when they rent. Because they've doubled the standard deduction. So the standard deduction for single people used to be $6,000, now it's $12,000. When you file jointly for a household, it used to be $12,000 and now it's $24,000. So in an instance, say you are in a family, and going back to the example before, you were able to deduct $18,000 worth of your interest and taxes. That's actually below the standard deduction now at $24,000, so you'd actually be taking the standard deduction. So there's not really as much benefit to owning versus renting, except that, as part of your monthly payment each month, you're paying towards your equity of the house, and there's benefits in that. But it's just not as good as it once was before. And the new tax laws, some of the things that you should know about the new tax laws are that you can only deduct up to $750,000 loan. It used to be $1 million, so it's lowered. So for more expensive houses, that could have an effect on you. And the second thing is that you're only able to deduct up to $10,000 from your state and local property taxes and your state and local income taxes. So depending upon your property, again, it might affect you. So what does this all mean? More people are going to be taking the standard deduction instead of itemizing it, depending upon their situation. So it's just one thing that has made owning a house not as appealing as it once was. So that's just important to know when you're doing your taxes in 2018. If you own a house, or if that was one of the thoughts that, I'm going to get all these tax benefits when buying a house in the future, you may or may not. So that's another great real estate tip of the week. Thanks for checking in. Bye-bye.